What's up, everyone? Welcome to another episode of Finance Simplified, the official podcast for Street Fins. We're here to break down the world of finance for you to understand from a relatable perspective with discussions with experts. This is episode 27, and I'm joined by my co-host, Alex Patel. How's life been since our last episode?
Hey Rohan, I've been well. Just recently moved onto Stanford's campus for a few weeks this summer, so it should be good to meet some new people.
That's awesome to hear. Palo Alto is going to be a great place to live for the next few years. Now, as we mentioned in the previous episode, we're starting a Discord so that you guys can interact with us more directly, giving us tips and suggestions for new episodes and improvements, as well as being more engaged with a community of driven people who want to learn finance.
Our hope is that this Discord will help our listeners connect with us and each other so they can learn finance from both this podcast and a community.
We'll be active on this Discord, promoting various topics of the week to discuss and having more conversations around our episode's topics. We'll also be accepting shout-out requests on the Discord. If you'd like to join our Discord and start connecting with our community of listeners, check out the Discord link in the description. Email us at fspodcast@streetfins.com if you have any trouble with accessing it.
We also want to remind you to follow us on social media at StreetFins on Twitter and Instagram for updates, and to sign up for a newsletter Finance Simplified for simplified weekly recaps, finance tips, and updates about the podcast.
So Alex, the topic of today's episode is simplifying value investing. What's this topic all about?
Value investing is probably the most popular topic across the investing world. Many investors like to talk about value investing and say they follow its principles.
From Ben Graham and Warren Buffett to today's investors, value investing has certainly evolved and withstood the test of time. Many successful value investors like implementing value investing philosophies, but put their own twist on it as well.
Even with those twists, value investing has some core ideas that are present in all successful investing, which we'll simplify today.
Right, and we'll be making this topic a two-part conversation. So this episode is part 1, and we'll be releasing part 2 in 2 weeks from when this drops. Additionally, we just want to remind you that if you're learning from our episodes and want to keep supporting what we're doing, we'd be eternally grateful if you gave us a 5-star rating and review on Apple Podcasts. Even if you're listening to this on another platform, as long as you have an Apple account or device, you can support us with the rating. Additionally, we'd love to know what feedback you have for us, so join us on Discord to send us any feedback to let us know how we're doing and what you would like to see from us going forward. Also, before we start this episode, I just want to give a shout out to USC student Cecil Franklin. He came in clutch by letting us record this episode at his place when our recording space was unavailable. We'll be teasing the next guest at the end of part 2, but this part 1 episode will go into the basics of value investing, contrarianism, viewing history, perceptions of risk, and much more. Our guest is an incredibly well-known and successful value investor who has also written several books about value investing. So, let's just get to simplifying. Welcome to Finance Simplified, the official podcast for Street Fins created by students that simplifies the seemingly complex
and confusing
world of money. We're your hosts, Rohan
and Alex.
Value investing is undoubtedly one of the most talked about topics, if not the most talked about topic in investing.
Value investing.
Value investing.
Value investor.
Our guest today is Joel Greenblatt. He's been an investor for decades now and has achieved incredible success in the industry. His career and thinking are well regarded throughout the investment world, especially amongst value investors. His background and career are both so impressive that I think I'll just let him introduce himself.
Sure. This is Joel Greenblatt. I founded a firm called Gotham Capital in 1985. I'm an investment manager, also have written some books, also for over 2 decades have taught at Columbia Business School. And that's as good a summary as any.
Yeah. So, this is a podcast that was initially made for students. So I'm kind of curious, when you were a student in college, what was driving you towards this career in finance that you've built out today? And more specifically, what kind of was driving your tilt towards value investing as the style of investing that you kind of have specialized in?
Sure. Actually, I was at Wharton undergrad, so it's a business school. And I read an article after junior year about this guy named Benjamin Graham, turned out to be Warren Buffett's teacher. And what I had been learning in business school to that point was that it was impossible to beat the market other than by luck, and that markets were efficient. And when I looked at the newspaper on a daily basis, it was pretty plain to see that most stocks that were trading, let's say at $50, there was something in the newspaper called the 52-week list, and it would show how high the stock's been over the last year and how low. And so a $50 stock today had usually been as high as 72 and as low as 32 or something like that. And my teachers were telling me, hey, 32 and 72 were all accurate at the time, or all efficient, or something of that nature. And it didn't make much sense to me. And when I read an article about Benjamin Graham, who said, listen, stock prices are emotional. What you have to do is spend time valuing a business, leaving a large distance between the stock price and what you think it's worth, which he called the margin of safety. And only buy things when you had a big margin of safety. And not only would that protect you from losing money, but sometimes even if you were wrong in your assessment of what it was worth, if you didn't miss by that much, you could still make a lot of money. So that resonated with me, kind of dovetailed much better with the way just observing in the newspaper the world worked every day with stock prices. And also, it was a little frustrating being taught that you couldn't outperform the market. And so I think it was an interesting challenge to try because all these smart professors were saying it couldn't be done.
Yeah, that's a pretty fascinating story into it. And, the title of this episode, and as we mentioned, the name of this podcast is Finance Simplified. And one thing that you've really done with your career is really spend time, whether it's your books or just other writing you have, other interviews, you've really kind of driven home this idea of making investing simple for others. So it's kind of like you're the perfect guest for this specific topic, not only because you're a value investor, but because you have this focus on simplifying it. And so with that being said, I was wondering if you could kind of talk us through a brief history of value investing for listeners who may not know the full story behind it, who are just getting interested in the space.
Yeah, I might not be the best one to talk about the history of value investing because, as Warren Buffett would say, all investing, if it's intelligent, should be value investing, as opposed to something that says, there are certain metrics that make a stock a value stock, low price book, low price sales, low PE, whatever it might be. It's not really the way I look at it. It's valuing a business as a holistic thing. It has to do with, how well a business is doing now, what its prospects are to grow its earnings in the future. And you put all those things together to try to come up with a reasonable valuation. And the part about value investing is basically figure out what something's worth and pay a lot less. And the way I look at it is I'm a private equity investor, and private equity firms buy entire businesses. And that's what stocks are, ownership shares of businesses. So when I value a business, we're really valuing it close to the way a private equity firm would. And a private equity firm is not going to say, this company is selling at a low price to book, or I can buy it at a low price to book, I'm going to go buy it. That's not what they're looking at. In fact, I know it's not what they're looking at. What they're looking at is how much this business is going to earn over many years forward, and how good are the prospects and how secure are those prospects. How am I going to value the value of that earning stream today? And am I getting a good deal? That's how a value investor should look at it. Private equity firm will also say, well, now I'm going to have control of this business. Can I improve on those earnings prospects? That's not something you get to do as a public equity investor, but the rest of the analysis is the same. And so that's the way I look at it. So the rest of the verbiage around value investing doesn't make a lot of sense to me, that it's defined in the way Russell or Morningstar defines it. It really should be defined as valuing things, being able to value something, and buying it at a reasonable price or a discount price.
Yeah. And, you're talking about that verbiage around it that doesn't necessarily make a lot of sense, right? So, and one of those kinds of things that I've observed is when we hear about this notion of value stocks and growth stocks, and the way you're defining it as, buying something, figuring out what something's worth and then paying a lot less. And then when you hear about these broad categories of stocks that are just categorized as value stocks, what do you really make of that? Is it really a value stock if, like you said, S&P or Morningstar just says that that's a value stock? Or it just kind of seems a bit odd that you would categorize something as value stock, describe this rotation, and then when value stocks are bid up and you hear of this rotation into value, are those stocks that have been rotated into, are they still value stocks anymore? So what do you make of sort of this categorization of that, and how do you just navigate that in general?
Yeah, I try to ignore it, right? The stock market is another phrase that's often used that resonates with me is the stock market is a market of stocks. We look at individual companies bottoms up, and how they're categorized by other people shouldn't really matter. And so I would suggest investors just ignore those categories. It is true that many of the stocks that we're attracted to, even if we value them as holistic businesses and look at their prospects, Warren Buffett said growth and value are tied at the hip, meaning growth is a part of valuation. A lot of times because the companies we're looking for are out of favor for various reasons, often they overlap with the typical definitions of value, but many times they're not. So I don't worry about it whether Amazon or Google is categorized as a value stock, as long as my valuation of those businesses tell me that the stock price is letting me own something that could be worth a lot more than what I'm paying. So that's really what I'm looking at. And, I think the problem comes with the fact that for most companies, it's very difficult to know what they're worth. I've taught at Columbia for over 2 decades. What I've told my students is, what do you do with maybe a technology business and the business is changing very quickly and the competitors are moving in and out? And it's just very hard to assess, what's going to be happening in the next few years and what's going to happen after that and how its whole marketplace is developing. How do you approach that? And my answer is always, well, skip that one, find one you can figure out. Buffett would say there's no called strikes on Wall Street, which means you can watch 20 pitches go by and no one's calling strikes on you. So you can just sit there until you wait for your good pitch. Doesn't mean you didn't miss a lot of good pitches that you should have swung at. But if the ones that you actually swing at are good ones for you, the outcomes will generally be good. And that's really all you have to worry about. You limit your errors of commission and you end up getting a good average over time.
Okay, that's actually a perfect leeway into the next question. I kind of want to go back to what you were describing during your time at Columbia, where it seems like your professors really professed about efficient market hypothesis and all the current public information is priced into stocks. And, I'm curious, why do you think value investing works? So clearly you sort of take the opposite stance that there are some inefficiencies. Maybe you think a stock's in a business that's just misunderstood and perhaps that there's something being priced into the stock.
So it was my Wharton teachers who told me, not to go into this business. It didn't make much sense. On the other hand, it's hard to answer your question because there are a limited number of companies that I'm capable of projecting. So I always try to make the job easier for myself. I wrote a book called You Can Be a Stock Market Genius, one of the worst titles of all time. And in it, I talked about how I tried to make the job easier for myself. And I opened that book with a description of my in-laws who used to own a house in Connecticut and would spend their weekend shopping for antiques, going into antique shops, going to yard sales and country auctions, and looking for bargains. If they found a painting that they were attracted to at one of these places where they were, scavenging around, their question wasn't, is this painter going to be the next Picasso? That takes a lot of talent and vision and expertise and a whole other bunch of soft skills that are very difficult to attain and to be right. And that wasn't their question when they found a painting they liked. They didn't say, is this artist going to be the next Picasso? Their question was different. Their question was, has there been a similar painting by the same artist that just went up for auction for 2 or 3 times what I can buy it for here? And if that were true, they would buy it. And that's a lot easier question. And they were sourcing their ideas a little bit off the beaten path. They weren't finding it on Madison Avenue, Manhattan at a gallery. They were looking, in places off the beaten path in country auctions and antique stores and estate sales and things of that nature. And their edge was looking a little, like I said, where other people aren't looking. Made the job a lot easier. So their skill set was in effect attainable by many people as opposed to one that perhaps wasn't. So one way that you can approach buying bargains is to look at in places that others aren't, look at things that are maybe smaller, like if you're looking at stocks, smaller cap stocks, looking at companies going through extraordinary change so that people aren't looking at it, looking at things that are a little complicated. So you got to go read the 400 pages. But if you did, most people would realize, that maybe you're getting a bargain, because they put in the work. So it was not more of a visionary thing. It was more of a legwork of either looking in more off the beaten path places or just doing a little more work or having some kind of edge or specialist in a particular industry because you're just familiar with that business better than most people. And so there's a lot of ways to get your edge. And, I wouldn't prescribe ahead of time which that was, but just make sure that you have good estimates. And sometimes you can just take advantage of it because people are emotional and some things that are clearly good for whatever reasons are oversold. And I've made money doing that as well. You just have to know it when you see it. And part of it comes from experience and part of it comes from making your job a little easier by only swinging at those pitches that make sense to you, that are very clear. And that's a very small minority of opportunities, but still plenty for an individual investor.
Yeah, and you're talking about this idea of investing off the beaten path. That's very much like a representation of contrarianism, right? That's a very important kind of philosophy that a lot of value investors follow and write about. My question is, we've heard Buffett and we've heard people like Howard Marks and yourself have talked about being contrarian investing where people aren't looking at the moment because that's where you can probably find the best bargains. Are there any limits to, being contrarian? Because sometimes people have kind of taken contrarianism too far and then they take too much risk, or they might find that it's just like kind of preventing them from finding other opportunities. So do you have like a certain limit on how contrarian you are being?
Yeah, I mean, just because most people won't step onto the highway because they might get hit by a car, so you go do it just to be contrary, that doesn't sound like a good way to be contrary. I mean, there's usually a good reason why people think what they think. And so I don't really view it as contrarianism. I would simplify it even more and say the contrarian part is to say that I understand what this stock or security is worth. For whatever reason, I found it in an interesting way, or I know this area or whatever, and having the confidence to check your valuation versus what the market is showing up. And the contrarian part is that the market's not always right, that sometimes stocks or securities are priced emotionally. And the contrarian part is to have the faith that if you understand, as Buffett would call it, your circle of competence, that you're good at valuing this thing, and it's pretty obvious it's worth a lot more than what you can buy it for. And just doing that, you might call that contrarianism. I wouldn't think of it as contrarianism. Contrarianism might be looking at the place where you're trying to find bargains in places that other people are shunning for whatever, they're out of favor. And so that might be a profitable area to look and to perhaps find bargains. And that's the only way I would think of contrarianism. It's not a good idea to step into traffic, and that's why people don't. So I would say, generally being contrarian is probably get you killed most of the time, or in the stock market, lose a lot of money. I would say being willing to be contrarian when you have faith in your own work and your own ability to value something, and you want to call that contrarianism because the market isn't agreeing, I would say that's okay. But I don't think it's a particularly helpful way to categorize things, that you're just contrarian. Maybe it's a good place to look for a industry group or other area that's out of favor. And that's a contrarian thing to do, but you still got to do your work. And, I always likened special situation investing, which is the course I took, value and special situation investing, as sort of saying, look, if you're digging for buried treasure, you don't want to dig up the whole neighborhood. You might want to look for an area that looks more promising. And so in that sense, to start digging. And that's really maybe where contrarianism might help you. Look in places that other people don't want, you're more likely to find a bargain. But, I have a great respect for the market in the sense that usually the market's right, but that's a lot different than saying it's always efficient. And there are plenty of opportunities to find where the market's being too emotional, too optimistic, too pessimistic, and to be willing to take advantage of that, given your skill set. I think that's the attitude you have to go in with.
Yeah, that makes a lot of sense. And contrarianism, the way you're speaking, it may point you in the right direction, but then again, you have to do your due diligence and make sure that you actually know what thing you're valuing. You're also just talking right there at the end about the difference between the markets being efficient and the markets being right, because it's really a question of when you look at the market, it can be right in the long term, which it usually is, but in the short term, there can be emotions, volatility, all these different factors that don't make it efficient for every second of time. At any time, it can be inefficient at any time as well. So I think that was a really important difference. So my next question is more about this idea of the market being kind of like a voting machine in the short run and a weighing machine in the long run. Recently, this market has been kind of an interesting one to live through with, the meme stocks happening in January and the influx of kind of short-term sentiment, short-term traders coming in. Do you think value investing can work within a market that only has short-term traders, or does there need to be sort of long-term investors who value things not in a way that's short-term trading or day trading, but who actually value things for the long run?
First day of class, when my class would walk in, I would always promise them that if they did good valuation work on a company, I promised them the market would agree with them. I just never told them when. So I think the good way to think about that is, anything can happen in the short term. Of course, emotions take over, but eventually what Graham called the weighing machine is what happens. The market eventually gets it right because the things that were uncertain sort of get resolved. Logic takes over. Things that weren't obvious become obvious. Things that people were worried about play out over time. And eventually the market gets it right. I don't know if that means 2 weeks, 2 years, 4 years, 5 years, but eventually it gets it right. And if you didn't believe that the market eventually got it right, you couldn't invest because then it would all be random and a little bit silly. So getting confused by short-term stock price movements, with the meme stocks or whatever. I mean, long-term, you really have to look at the value of the business. Now with the meme stocks, if they start raising money at these higher valuations, what George Soros calls reflexivity, you can make some of it come true. You can, keep yourself from going bankrupt by selling stock at very high prices. And maybe it won't justify the price that you sold at, but will certainly be higher than it would have been without that period of meme stock success. But it's just not the right way to look at it. Yes, the market will eventually get it right. I still promise you that. When is the other question. And I think the secret weapon investors have, I wrote a book called The Big Secret, and I always make the joke, I wrote it in 2011, I always make the joke that it's still a big secret because no one bought the book. But the big secret was patience. If you have the patience and you do a good job of valuation, the market will crisscross with that valuation at some point down the road. And that's the way to think about the world. What happens in the short term? Anything can happen. We saw that last year with the pandemic. That was something that was not in anyone's playbook. It was horrific, but it was nothing any of us have really seen before, could plan for otherwise. And the market fell 30, 40%. Then it went up a lot more. If I told you at the beginning of 2020 that we were going to have this giant pandemic and everyone would be locked up, and then predicted the market would be up a lot in 2020, people wouldn't have imagined that. But one way to think about that is that the value of a business comes from the value of its discounted cash flows over the next 20, 30, 40 years. And, the next 6 months or the next year is really just a small piece of that valuation. So what you really want to look at is normalized earnings 2 or 3 years out, and how much of those earnings are going to grow over time, and how secure are those earnings? How good are your expectations? And that's the way to look at it. And that was one way to get through the pandemic. Much easier said than done. But when you think about it, as long as this is a short term, as long as you have a balance sheet that can get you through, it was possible to make that money. But, predicting short-term stock price movements, even if you knew what the news was going to be, what the Fed's going to do, any of those things, really, I haven't met anyone who's particularly good at that. There are a few, but they're very few. I mean, a handful of people are really good at that. And for most of us, we want to be patient, take advantage of the fact that the market will eventually get it right, and just be patient enough to live through whatever you have to live through until that happens, or that you're proven wrong.
Yeah, that's a great point about the pandemic. And I think a lot of the investment world really saw the pandemic as a stress test for companies. And it did highlight a lot of areas where value investing could work, because companies were down 50% when there was really no material change in their expected cash flows 2 to 3 years out, as you said. I'd like to pivot actually to a sort of discussion on risk. And I'm interested in hearing maybe what your perspective is on risk as a value investor, and maybe compare that to growth investors. Do you view the price that you pay for a stock as the ultimate risk that you take on, that just the price goes to zero and you lose your entire investment? What are your perceptions of risk?
It's not really the stock going to zero. It would be that you overpay for something. You pay more for something than it's worth. That's your risk. Okay? Looking at short-term volatility measures isn't your risk. Your risk, if you're a long-term investor, is that you overpay for an asset, and you could overpay because your assessment were wrong or something bad happens, right? Just unexpectedly bad happens. So those are the ways you lose over the long term. Or perhaps you could lose because you leveraged your portfolio and you're forced out at a particularly bad time. Or You have clients, if you're an asset manager, who leave during your period of underperformance before the market recognizes the value you see. So those are the various risks that you're taking, but the risk to investing is really that you just overpay for something, significantly overpay for something. And otherwise, all those other, I think, volatility and other measures are used because you can measure them. And you can measure them in short term and run them through math models. But that's not really your risk. Your risk is that your assessment of what the business was worth was wrong, or what the security is worth is wrong, and you overpay.
Yeah. So essentially, you're kind of viewing price as kind of like that ultimate indicator of risk, because yes, you can overpay. And I think it's important that, it's not necessarily as quantifiable and measurable as volatility, which is essentially a historical measure of how certain stocks have behaved. But price and understanding that you have overpaid for something, that only happens once you actually lose the money you have. So yeah,
I'll simplify it a little more. The two numbers you need to know are price and value.
Right. So so the next question we have is, a lot of value investing really kind of looks not only at, price and value, but also has a huge emphasis on history, with understanding, what it translates to in terms of the price and value. So my question for you is, as a value investor, what do you think stays constant throughout history and what changes? So just through, your study of past market movements, or even just broader events in general, what do you think is a constant and what do you think is variable?
It's hard to know. I mean, businesses morph significantly. If you just look at the S&P 500, the types of businesses that make up the S&P 500, because it's market cap weighted, are a lot more asset light than they were 30 years ago. Number one, some of the market's more concentrated, meaning the top 5 names are somewhere around, I don't know the number, but 20 to 30% of the index. Those businesses are some of the best businesses I've ever seen. So that's an interesting difference. But once again, I think the best way to look at it is a market of stocks. Interest rates change over time, and how the Fed works changes over time, and how that affects interest rates. Very hard for me to assess that, but obviously interest rates are a lot lower than they were. And if you believe they're permanently lower, which I don't know the answer to that, then you might make a change in how much you're willing to pay for things. And, so things change all the time. It's a complex adaptive system. If you know one or two things that are different, that doesn't mean that there aren't a lot of other things that go the other way that you're not aware of or aren't able to assess. And so once again, I try to simplify things in a sense that I'm looking at individual companies. I'm looking at their expected cash flows and how much they're going to grow. Realize for most companies, I'm not going to be very good at it. And just to stick to the ones that I feel like I have an edge, or I found in such a way that if anyone had found it in the way I did, they would have saw it was cheap too, that it's trading at 1/3 of what similar companies go for. But I found it off the beaten path, or it's a spin-off, or company's been recapitalized, or it's closing down a money-losing business, or who knows, any of those things that make it a little bit easier and really hide the bargain that you're looking for, and there's a reason for it. Those are all ways that you can still make money. And I would just say that you have to keep learning. I think it's a business where if your level of understanding of how the world works stays stagnant, you won't be able to value businesses correctly or understand what's going on when things change a little bit, or the dynamics of business change. But it still boils down to sticking to things that you can value and buying them when you can buy them at an attractive price. And that's it.
Hey everyone, that was the end of part 1 of our 2-part interview with Joel Greenblatt on simplifying value investing. We'll be releasing part 2 of our interview in about 2 weeks from when this releases. But the first half of the conversation was absolutely incredible. Alex, what were some of the key takeaways from this first part?
One key takeaway is that value investing shouldn't be treated as a categorization of stocks or assets. That type of categorization can be very counterproductive, and the best thing to do, as Joel does, is just ignore all the commentary about quote-unquote value stocks and growth stocks. There are cheap stocks and expensive stocks, and the approach that value investors take is to figure out the best opportunities through diligent valuation work.
Right, and I also agree with Joel's perspective on contrarianism in investing. It's not supposed to be your topmost priority to always be contrarian. However, looking in places that are beat down for opportunities can be considered contrarian, and also being willing to be contrarian with your bets until they succeed is also important. But contrarianism really just points you in a certain direction and eventually it comes down to trusting your own work and research.
I also think what Joel said is very important in how he thinks the stock market is somewhat of a misnomer, and that the stock market is a market of stocks, where stocks are just things that are traded. Rather than think about it that way, it's better to just treat the stock market as a market of individual companies that you can find value and find opportunities in. The bottom-up approach seems to be very prevalent amongst many prominent value investors.
Agreed. Well, Alex, that wraps up our part 1 conversation and takeaways. What can we expect from part 2?
We can expect to talk about growth investing in relation to value investing, Joel's take on the current market, what Joel thinks about investing now, his career as a teacher, and much more.
Part 2 will be dropping on August 15th, which is 2 weeks from now. We'll talk to you all then. Hey guys, I want to thank you so much for listening to this episode of the podcast. It truly means the world to us. If you like this episode and others, let us know by subscribing and giving us 5 stars on Apple Podcasts and following us on Spotify. Share us with your friends and check us out on Instagram and Twitter, both at StreetFins. You can also follow me on Twitter at Rohan Invest. If you'd like to get in touch with us, please email fspodcast@streetfins.com. Thanks once again to Joel Greenblatt for his insights today. I hope you understand the topic of value investing in a more simplified way. Once again, we're really happy that you're taking the initiative to learn finance and to better your future. If you haven't already, we highly encourage you to check out streetfins.com for articles, videos, and other content. Join the StreetFins community and tell your friends about us so that they can learn about finance too. We'll talk to you next time on Finance Simplified.